On Monday, the IMF released its regional economic outlook for Latin America and the Caribbean and said that external risks to the near-term outlook had receded. Policy actions in the euro area and the United States have removed immediate threats to global growth and financial stability, according to the report.
2013, we're expecting a year that growth is going to post 3.4% for the region as a whole, compared with 3% in 2012. That encompasses some countries that will be growing at around 9%, such as Panama, and countries that will be growing much less.
According to the report, the key risk for the region would be a reversal of the easy financing conditions and strong commodity prices that have prevailed since 2010. The region would be particularly affected if a sharp slowdown in China or other key economies triggers a drop in commodity prices. The report said that countries in the region should take advantage of the current favorable economic conditions to build a strong foundation for sustained growth in the future. Policy priorities include building stronger fiscal buffers, improving policy frameworks, and pressing ahead with structural reforms to increase productivity and potential growth.
In 2013 for Brazil, we are expecting an increase in its growth rates of around 3% this year, which is higher than the growth rate in 2012. That was approximately of 1%. That basically reflects a lot of stimulus and measures taken in 2012 that are going to pay off in 2013. To maintain those growth rates and above all to increase them in the coming years, Brazil will have to accelerate the execution of its infrastructure agenda to attack the bottlenecks in that sector and also accelerate some structural reforms to trigger productivity in the country.
Lower U.S. growth would have a negative impact on the region, particularly in Mexico and Central America, where links through trade and remittances are the strongest. Growth in the other commodity exporters is expected to increase to 4.6% this year from 3.3% in 2012. For the energy exporters such as Bolivia, Ecuador and Venezuela, growth is projected to moderate in 2013, and much of the Caribbean, high debt and weak competitiveness will continue to constrain growth. These economies are projected to expand by about 1.25% in 2013, up from 0.5% in 2012, as external demand strengthens gradually.
Mexico has been benefiting from the recovery of growth in the U.S., and especially the recovery of the manufacturing sector in the U.S., and therefore exports have been doing quite well in the last few years. They have been supported also by low natural gas prices in North America, by lower labor costs relative to China than the ones we observed, let's say, 10 years ago, and also by a significant reduction in transport costs and logistical advantages in integrated its manufacturing platform within North America.
The IMF said these countries would benefit from saving a much larger share of their commodity revenues. The key challenge for these countries remains reducing high public debt, containing external imbalances, and reducing financial sector vulnerabilities.